Thank you guys for stopping in. So I literally just got back from vacation, and so much has evolved from the whole 3AC Contagion situation, and that's what I want to cover with you guys today, because there's a lot of big news that broke. So first of all, Voyager, despite having been given that loan from FTX and Sam and Almeida, they are filing, I believe it's Chapter 11 bankruptcy. So they are really the first one to completely be out due to Three Arrows Capital. It seems that even despite the credit line that was given to them, they just were not able to continue operations, and so they filed for bankruptcy. So they are officially down for the count. Again, that's Voyager. Next up, Celsius. So this whole Celsius situation has been really hairy. And I'm going to play you guys a clip that they had with Peter Schiff. So Alex Manchinski, who is the CEO of Celsius, was on a news network show. I'm not sure if it's Peter Schiff's show or if they both were just guests on a news, like some sort of finance show or what. But Peter Schiff, who for those of you who don't know is a gold bug, and gets a lot of hate from the crypto community. He throws a lot of hate at the crypto community, so a lot of it's rightfully deserved on his end too. But there's been a lot of back and forth there. His son is big into Bitcoin, which is kind of funny. So he's a gold bug and his son loves Bitcoin. So I thought that maybe I would be able to use parts of the video of that Peter Schiff discussion, but turns out the whole thing's copyrighted, so I cannot. I will include the link down below to this clip. I highly recommend you guys check it out. But essentially what's going on in the clip is Peter Schiff is asking Alex Manchinski, he's saying, where do you guys generate the yield on the Bitcoin that's being deposited? You know, where's that coming from? And Alex keeps saying that Bitcoin pays dividends. Bitcoin pays dividends, which we know is not true. Bitcoin does not pay dividends. No one gets money out of Bitcoin besides the miners. They are the only ones that generate money from the Bitcoin network, and Celsius is not a miner, and that is not how they're generating their yield. So Peter Schiff keeps digging at Alex and saying, no way, like, what are you talking about? Like, you have to be taking tremendous amounts of risk in order to generate the type of yield you are offering on Celsius and on the platform. You know, what are you doing? And so anyways, guys, check that clip out. Again, it really just kind of pulls back the veil, I think, a bit on Alex Manchinski because, man, this guy is a piece of work. Well, it turns out they were lending it, which is really what we're coming to find here. And I think for some of us, we understood how this all worked, but the problem I have with these institutions is that the lending piece was not made clear to consumers. Not many people understood exactly where the yield was coming from, and you had advertisements like this. This is from Voyager, talking about it being just like cash. You can see in this that there's like 3 lines where it says like cash. It talks about earning yield on USDC, which is the equivalent or a stable coin, which is a lot like cash. That's what they keep using in this. Earn 9% interest basically and treat it as a savings account. That's the message that most consumers got. They didn't understand that there was risk here. It wasn't like these people were depositing their money thinking that they were going full-fledged degen into crypto. But that is basically what these institutions were doing with the money that was lent to them or deposited in their platforms. They were taking it and just totally degen lending it out. And I think most people would not have deposited their money in there had they known this. And so anyways, getting back to Celsius, again, this was before we really knew how Celsius was generating its yield. Most of us had inklings. Again, Peter Schiff thought that they were trading it. Well, turns out that Celsius was quite literally running a Ponzi scheme. All right, so I have a tweet here that was put out by DB at tier 10K on Twitter. And it says, faced with a liquidity crisis, Celsius began to offer double-digit interest rates in order to lure new depositors. So they increased their interest rate offering to bring in new depositors whose funds were used to repay earlier depositors and creditors. So they're taking new money and paying old money. That is quite literally a Ponzi scheme. So this was going on, from my understanding, prior to the whole 3AC situation. So they were running a Ponzi before 3AC even collapsed. And then when 3AC collapsed, the Ponzi fell apart, which is usually how it works. When someone stops paying, the Ponzi falls apart. Or when you can't get new depositors, it falls apart. In this case, again, it was the 3AC default that caused the Ponzi to fall apart. And the whole thing was exposed. So I'm sure there's going to be some lawsuits coming out of this, because Celsius and Alex were quite literally running a Ponzi. And then to top it all off, we got a tweet from Fat Man, old reliable Fat Man. Thank you for your diligence, Fat Man. We get a lot of good research from your Twitter account, so I appreciate that. But he says, on-chain data indicates that Manshinsky was using customer funds to bid up Cell, which was the Celsius token, but was dumping his own Cell allocation simultaneously, all while shilling it to his customers straight out of the Do Kwon playbook. Exude confidence, shill hard, sell into ensuing liquidity. So he was literally pumping you're trying to pump the token, shilling it to everybody to make them his exit liquidity. He was dumping on them as they were buying the token so that he could unload his sell token position. So, I mean, good Lord. Like, this guy, what a piece of work. And I know crypto regulation is a hot button topic for a lot of people. But I think for these centralized entities, at minimum, they do need some regulation, guys. They're operating as basically a bank, but without any of the same regulations as a bank. They're lending, they're taking deposits like a bank does and lending them out. So if they're going to do this, they should have to maintain certain liquidity levels. And so I think that this is important regulation that could come out. That, again, I know a lot of you guys might not look at it as something that is exciting or what you might want to see, but ultimately I do think regulation like that, like minimum liquidity requirements, would be good for the space at the end of the day for these centralized lending institutions. I also think that we need more transparency in the crypto space. Had these companies been more transparent, had they provided guidelines for what they were planning to do with the deposited crypto, the risk parameters that they had set in place, their underwriting guidelines for when they were lending to other institutions, I think that's all information that should have been shared that wasn't. And if you guys are interested in hearing more about the Celsius situation, Fat Man shared a thread from OXB1. It starts off, it says, "Hi all, I'm Jason Stone, and from August 2020 until April 2021, I led the group of talented individuals who manage the OXB1 address. Before leading OXB1, I spent years." So he goes into his background. Basically, what OXB1 is one of the wallets that was working with Celsius. And this entire story it's super interesting. It's a very long thread, so I'm not going to go through it in this video. But again, if you want to read about it, it talks about one of the wallets that this individual helped manage for Celsius that was supposed to be hedged. Turned out it wasn't being hedged. And he goes into all the details of that. So again, check that thread out down below if you want a good read on that. And then the new group that has been affected by 3AC is blockchain.com. Apparently they're a crypto exchange. I've never heard of them. It sounds like they lent $270 million to 3AC. That is heavily affecting them. Again, I believe that they're a smaller group. I've never used or heard of them, so I'd imagine $270 million. I mean, that's a lot to any entity, but especially to a smaller exchange. So they are now the newest one to come out and say that they have been affected by 3AC. And as an update on Sue and Kyle Davies, not even their lawyers know where they are located at the moment. So they are at large as of right now. No one really knows where they are. Obviously, we've got lots and lots of lawsuits flying around. And I'm sure that this is going to continue to evolve. Again, super interesting that all of the entities that were heavily affected were all centralized financial institutions. The DeFi protocols have held up extremely well despite their exposure to Three Arrows Capital. Again, I think that right there is proof in the pudding of how DeFi can provide better systems than centralized financial institutions. Again, obviously, these are not the most cleanly run institutions, so it's not to say that this, if we really got a group of good individuals together, I'm sure you can make a centralized lending institution work very well in the crypto space, but these guys got greedy, saw dollar signs, and now we are seeing this all play out. So with that being said, guys, I'm going to leave you with a bit of a puzzle that CZ gave us. I'll let you try to figure out on your own who this might be. But the Twitter thread starts, someone asked CZ a question. It says, have you or Binance ever been approached to participate in these loans? Seems like most big crypto entities are involved directly or indirectly. CZ responds, it does happen quite often, and this is my usual response. This is from a relatively famous OG in the space. Previous post, the image got cut off. And it's a text thread, and it says, this isn't something we do. It'll take a lot of effort to get Binance to do it. Many people involved, long decision cycles, etc. It won't be worth the holders' time. Sorry to be direct. Saves time on both sides. Whoever CZ is messaging asks, how about you personally? Direct questions and answers always save time. You get half the upside with zero downside risk. Who does this sound like that we know in the space? A zero downside risk loan, right? And then CZ responds, I don't do any personal investments or deals. Takes too much time to get contracts verified and to track it later. I always have to get them involved, so I do everything through Binance. Then whoever CZ is talking to says, is your team interested in making a $120 million loan backed by $4 billion in assets where I can pay an interest rate or share part of the upside? No, this is outside of our normal business. The amount of work involved setting this up and tracking it is not worth it. It just distracts the team from our normal business, which we are already tight on resources. Understood. Thank you for the reply. Good luck with the Binance withdrawal issues as well. The nerve of whoever this might be to, first of all, ask CZ for a loan, lie to him and say that they have $4 billion in assets. Mind you, these were all, 90% of them were lent or locked up. Of course, they don't mention that here. And then to throw a jab in at CZ at the end of this regarding Binance withdrawal issues. CZ addresses this and says it was because the individual was withdrawing $120 million and had to wait 2 hours for the withdrawal to complete. So they threw that jab in at the end. Again, you literally can quite literally not make this up. It is absolutely ridiculous. Anyways, guys, I appreciate you stopping in. If you are new to the channel, please like and subscribe, and I will see you guys next time.